Last week was an incredible week. There was a lot that happened with respect to the markets, with sell-offs, with inflation, with a lot of different aspects. So we want to dive into some of those details today, and then we're going to be covering some of the portfolio changes that are occurring. And lastly, we're going to be discussing some wealth management ways that we can be working with your income streams. So there's a lot to get to, but let's dive in. Let's start with number one, economic and stock market risks. There are not a lot of guarantees with the economy, but there is one guarantee and one constant that we can count upon, and that is change. You see, with the economy, there is a lot of change that is always occurring, and last week was no exception. We saw an increase of inflation, and yes, we're starting to feel this across the board. So we've already been seeing increases with, say, insurance, whether it's car insurance, healthcare insurance, property insurance. We're starting to see it with other avenues as well. So we're starting to see things like the age of your car, and the used cars are starting to inflate. You're starting to see that in housing. You're starting to see that in rentals. Well, that's a lot of inflation that's starting to pick up. So property taxes are going up. Food prices are starting to climb. And when we look at all of this, you can start to see that inflation is a little more sticky than what the Federal Reserve had realized. We call this the echo effect. And what's really going on now is that the consumer price index, what we call the CPI, is still trying to play catch up to what we're starting to see. So all the reality and all the different really inflation that's out there is now just starting to be built into the consumer price indexes. So what that means is that inflation is likely to be here longer than anticipated and longer than what the Federal Reserve would like. So that's going to keep our interest rates higher. That's going to keep mortgages higher, but that's also going to play havoc with other investments like some of the banking sectors as well as real estate. So there's a lot to do there and a lot to think about. But there's also some resilience. And yes, the stock market has been resilient over the last week, and it's really no part and thanks to, well, basic materials, energy, utilities, some of these other areas that we don't necessarily think of being great areas to be invested. They're actually areas that are doing very well in this environment. So one of the things that we look at here is that, again, change is happening. We have predicted that we would have this lead to scenario where we have growth of our economy and growth of inflation happening between now and basically the rest of the year. But with what we've been starting to see and how quickly inflation is starting to pick up, that actually is signifying that maybe for the second half of this year, it may be a little bit more of a lead 3 type of a strategy where we're taking a look at not a lot of growth in our economy, but more inflation. So what do we do with that? Well, see, this is a little bit different than, say, where we're at in Europe and where we're at in some of Asia with respect to they're going to be in a lead 2 scenario, and that's mathematically where we're at. So they may actually be better investments than here in the US. But that doesn't mean we can't find great investments in the meantime. So that's really what we want to be aware of, is that there's going to be changes that are happening, that we may not grow nearly as much as anticipated, but inflation is definitely going to be there unless the Federal Reserve does something to really tamp down quickly, which they may be unable to do in an election year. Number 2, portfolio changes. So in response to what we're seeing here, all these changes with the economy, yes, we have pulled back and we've added some, well, money market type investments just to provide some good, well, safe havens while we're waiting out some of these unknowns. But that's not the only place we can be. See, there's a lot to do with diversification into metals and miners. And where that really shines, yes, I understand that was a pun, but where that really comes into play is the fact that we can be taking a look at energy. And this is something that we've been talking about now for a couple of months. The energy sector itself is really good to be a gauge against inflation. But also, we're starting to see copper miners starting to pick up, silver miners starting to pick up, uranium. All of these metals that we have been looking at are really starting to work well. So when we take a look at that, we add in some of the other elements that we are talking about with, say, emerging market technology, with India, with Germany. All of these areas are great places to be because they're in the correct countries that are growing. That's why we like them so much. And then China is really something that we've been talking about a lot as well, that if China is really coming out of this industrial, recession that they've been in for the last couple of years, you can start to see a lot of other places in Asia pick up. And what is really the driving growth that we see there? Copper. When copper is going up, it's because there's a lot of demand that is occurring, and that is industrial, that is manufacturing, and that could very well likely be China. So there's a lot of different things that we can be, working into in the meantime, even though there may be some volatility here in the United States. Number 3, wealth management and advanced planning. As we navigate through a lot of the complexities with the financial landscape, I want to take a step back here, because as we go some of this planning, there's actually some great opportunities that you have to reduce some of your taxable income. Now, yes, I understand that this is usually not a strategy that we want to be talking about here with, your wealth management, but it may be needed. It may be that we don't want to take income this year. We may want to postpone that or even gift it to other generations. But there are a couple items that we can be looking at. The first one that you probably have already been doing and really working with is what's called tax-aware investing. And that's just making sure that we have the correct investments in the correct accounts with a focus and an eye on taxes. So when we take a look at that, we take a look at the dividends, we take a look at capital gains, we take a look at how these really investments are playing out, and that's a piece of it. But what if we want to have other avenues for deferring some of this income? That's where an incomplete gift, non-grantor trust, can actually come into play. And what that will do is have a trust that reduces your state income tax while actually maintain some of the control over your assets. So this could be a very good way that if we have a high amount of income producing assets, think of it like, say, maybe a property that you own that is paying out some of these dividends, interest, and even some of the rent along the way. That may be one avenue you may want to consider. But there's also another one as well. It's called a captive insurance company. And what this does is actually establishes a private insurance company, generally for your business, to help you manage the risk. But you can also provide tax benefits to you as well. So that may be a way to do some more income smoothing plans and maybe defer income for a future time. So yes, there's always things to do. And when we employ some of these sophisticated strategies, basically what we're looking to do is start protecting some of the wealth, but also provide some growth that's in a tax efficient manner. And that's really where this comes down to, the tax efficiency behind it. But when we take a look at this, yes, we want to make sure that we are bringing in your CPA, we're bringing in your attorneys, we're taking a look at this in a holistic much, not just with one piece of the element. We want to take a look at all the different pieces to make sure it's going to be right for you. But those are and can be very good strategies. Number 4, our second opinion service. There's always a lot to talk about when it comes to wealth management, and a second opinion is vital. You see, for someone that you know who may want a second opinion, this provides the opportunity to go through our second opinion service where we take a deep dive into all that they have going on, figuring out where they're at today, where they want to go in the future, and then understanding where gaps exist. Now, of that, one of 3 items will come out. Either they're in a good spot and we'll let them know, or maybe they have a couple items that they need to address and they can actually improve their situation by doing so. Or last element, maybe there's some larger gaps and we're going to provide a strategy to bridge them. But either way, they can go away knowing that there's a strategy and a way forward so they can help to better their overall wealth plan. That's the power of the second opinion service. And again, let us know if you have someone that would like to go through the process. Well, we've covered a lot. And as we are going through this, I know you may have questions. Feel free to reach out. We'd be happy to talk and actually walk through those questions that you may have. See you next week.